All right. Hi, everybody. Jack Trammell and Guy Terrell here, authors of the Stock Market Cookbook. This is podcast number 2, and we're doing some cooking. And of course, where else would we be but in the kitchen? And Guy and I have been just talking about all kinds of things this morning, including the recent dip in the market that had some people scared and wondering what they should be doing. And so, Guy, I'm going to ask you a few questions that relate to things that we've been talking about this morning. But first of all, let's go back in time a few weeks ago when there was a sharp dip in the market and people were feeling a little nervous and itchy. And so, can you talk to us about how people should be reacting when things like that happen?
We're small investors, meaning very small, not millions of dollars, hundreds of dollars, and we hope to grow it to thousands of dollars, and over time grow it even farther. Here's the thing: forget the market. Just do not let that market drive your decisions. In other words, I had what was it that I owned? Well, I owned some Nvidia, a few shares, and they went down. And I said, I'm not going to do anything. And within a short time, they were back up. I also had some Micron technology, and that went down, and it stayed down. But over the long period of time, an individual stockholder cannot jump in and out of and around in the market. We have to have a different focus. We have to say, what's this stock going to be next year? If it's not going to be at this price or higher next year, maybe I do need to sell it. But I believe that they will be higher next year. So it's a small amount of money, keep it.
So basically, ever since I've known you, you've been preaching patience and that you have to be ready to be in for the long haul. Now, that doesn't mean that you don't make adjustments and do some trading, right?
Right. But over and over and over, and the story is that the lesson will be repeated until you learn it, and that is buy and hold stocks. This is what our forefathers, the grandfathers did. My grandfather, he would buy something and then it was still in his lockbox when he passed away, and it grew and it grew, and that's what we have to focus on, not what is going to be next week, next month, next year, but what is it going to be in 5 years, in 10 years.
So, for some of you of my generation, you might remember the story of Walton and Walmart. My grandfather bought stock in Walmart and just held it for like 40 years, and it split numerous times. And of course, when he bought it, it was not very expensive, and it ended up, I don't know how many thousands of dollars, but it was worth a lot, and he just sat on it. And in fact, some of us grandkids didn't even know he had it until he passed away, and that was one of the things we found out, that he had bought 100 shares and just sat on it, and it split and it split and it grew and it grew. And
But not every stock that you buy is going to do that. You're not going. Every stock you buy is not going to turn out to be Walmart. But let me give you a concrete example we were just talking about, and that's Construction Partners. Their symbol is ROAD, road. You can't.
we were just talking
that.
about them.
They have, in the last 5 years, they have more than doubled. And I would predict that they're going to double again. Maybe not in 5 years, but they're going to double again. They build highways and infrastructure in the Southeast, Georgia, South Carolina, North Carolina, etc. You can look it up on Yahoo Finance. And they control the process from start to finish. And this has enabled them to be very profitable, and they have good management, and it's a hidden gem that most people are not aware of. So this is one that it'd be suitable for you or me or anyone listening to add a little bit to your portfolio.
So let me elaborate on that a little bit, since we're talking about the stock market cookbook and we're talking about recipes for financial success with the market. Road is a regional company, so it's not an international multi-billion-dollar corporation, although they are a big company, obviously, to do what they do. But in terms of capitalization and really big stocks, one of the things you and I have discussed is the relationship your portfolio should have in terms of how heavily should it be weighted with the big shot stocks, the Amazons of the world, or how much should it have of the Rhodes of the world?
It's like going to a Chinese restaurant. You order something from column A, something from column B, something from column C. And I hope I didn't offend anybody for using that reference. But
I like Chinese food. I think you're okay.
But you could have an Amazon in your portfolio, and you could have a road in your portfolio. Just know what you're buying and know that you have to hold it. Amazon seems to be doing everything right. They have been doing it for now decades. So I would say that Amazon, even though it's a high price stock, and you're not going to suddenly go from, I don't forget how much it is right now, but it's not going to double in the next 2 years. But give 5 years and it might get close to doubling. And doubling is only 15% a year. And that's kind of what Wall Street expects from companies.
So getting back to the stock market cookbook, it's supposed to have recipes that you can follow, and we do have some in there. For example, there's a recipe where when you get windfall money that you didn't expect, you earmark that to your trading account, and you can allocate it in certain ways for smaller amounts if it's just a few hundreds of dollars or something. But in the course of talking about these different recipes, this morning Guy started showing me 5-year trend lines of dozens of different companies, and I was amazed at how clearly you can see some companies are just like the trend line. It has the ups and downs, it has the dips, it has the market adjustments, but the 5-year line for a lot of these companies doesn't lie. It really looks like it's just going up over time. How would you summarize that?
Wall Street, if you go to yahoofinance.com, or financeyahoo.com rather, it's said that they've got bunches of headlines and people saying, oh, you need to buy this stock because Warren Buffett bought it. You need to buy this stock because Morgan Stanley has rated it to be a buy and that it's going to double in a year. Forget all that. Do not listen. Listen to yourself. Buy the stocks that make sense for you, that you have faith in, and just sit on them. Look at Warren Buffett and Charlie Munger. They built Berkshire Hathaway because they bought some companies and they just sat with them and sat with them and sat with them. And that is the hardest thing to do as an investor, to do nothing. In the book, we show examples of a friend of ours that we advised to buy stocks. And she did, and she held them. She didn't have the need for the money. Eventually, we'd had to sell some of hers. She needed some money. But I'm amazed. Her portfolio has done better than anything I put together for myself or you have, just because she did nothing.
Well, she did nothing, but she started with something, and so you helped her pick those stocks out. What drew you to Apple, or what drew you to those stocks? Was it those 5-year trend lines? Was it a mixture, diversity? Was it?
It's a mixture. You look at. I tried to find what was being recommended. At that time, I was using Merrill Lynch mainly, and look at what their analysts say, what they predicted. And analysts flip on a dime. They will say 1 month, oh yes, you should buy Walt Disney. And then Walt Disney has a bad earnings report and says, no, you should avoid Walt Disney. Well, think like your grandfather, or distance yourself from your own account a little bit and just let it be.
I remember one day, this was a couple of years ago now, there was a pretty sharp correction in the market, and Guy sent me a text. He said, "Don't even go and look. Just leave it alone. Don't even log in. Don't even bother." And so patience is called a virtue, but I guess in terms of the kind of investing that we're discussing, it's more than a virtue. It's absolutely the key.
Because you're not buying a stock. Okay, a company, let's pick a company, Walmart. Walmart can have its sales affected by anything. Target's a better example though. Target every so often will have a bad earnings quarter. And they correct what they're doing, and then the stock will go up again. Oh, and when they come out with bad earnings, the stock takes a tumble. That's when you should buy it. Because if you look at the trend line, it goes up, 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 up. But in between, there are many variations. Look at what Target has done over the last few years. They have a solid management team, and they correct what's going on, and they seem to recover.
And I guess if we went and looked at their 5-year trend line, it would look like some of those other companies you were showing me.
It would look like it'd still be going up, but it would look like a serrated knife at the top. And that's what you have, and that's where all the pundits and all the news feeds, they're looking at these gyrations in prices. Gyrations in prices will cut your throat. Forget it. Look at the trend line, which is smooth and will not cut your throat.
Now, part of the reason Guy and I took up this project was because we are interested in the forces that work in the market and why some companies succeed and others struggle, how the market behaves in reaction to policy. And there's just a whole rabbit hole you can go down there. And ultimately, we realized that many ordinary Americans just want to have a little bit of a say in how their family finances are managed. And so the Stock Market Cookbook grew out of this idea that we don't have to become full-time financial advisors or become licensed brokers in order to have a small amount that we manage ourselves for our family finances. So for those of you who are following us, you know this already. The Stock Market Cookbook is a manuscript that is completed but is on its way to publication through a GoFundMe program that we are going to be getting up in the next couple of weeks. And so it's filled with these recipes for ordinary people who want to have some success with the money that they can spare to put into an account on their own. And it's also designed to help you learn from the lessons that we have learned in terms of you could spend the rest of your life researching, but if you're like us, you don't have time to do that. But you are interested enough probably that maybe 30 minutes here, 30 minutes there, you do want to click around a little bit. And so the Stock Market Cookbook is designed to give you quick ways to find out about that 5-year trend line and why it means so much, and why there are some important predictors and elements to look at when you sort out the wheat from the chaff. So, Guy, any final tip for the day?
In closing, I will say what a good friend of mine said to me long ago. He said, "Play your game, not their game." And that's what you're not Warren Buffett, you're not anybody but yourself. And so don't compare yourself to everybody else. What are you comfortable with owning? Do you want a dividend, etc., etc.? So we're working on the book to give you all the answers you will need.
And always, at the moment, I will remind you that Guy and I are not current licensed brokers at the moment. Our advice, our ideas are like any kind of financial endeavor. They involve risk, and you should be cautious and do your own research. And we don't take liability for the market crashing tomorrow, but we are citizen investors who think we've got a lot of great ideas for you. So we'll look forward to podcast number 3, which will be coming out in a couple of weeks here. So have a great day.